Vanakkam, Namaskar. Welcome to this edition of Fixed Income Market with Sundaram Mutual Fund. In this update, uh, there were two important events which unfolded. We'll be looking to cover that. One was the Union Budget, where the market was looking for two important numbers. One was the fiscal deficit number, the other one the borrowing program number. So both these numbers were higher than what the market was anticipating. In the fiscal deficit number, the current year, the fiscal year 22, the fiscal deficit number was revised upwards from 6.8 to 6.9%, while in FY23 number, market was anticipating a number of 6.1%, came in at about 6.4%, and consequent to that, the borrowing program number was quite high than what the market was anticipating, almost 3 lakh odd crores higher than what the market was anticipating at 15 lakh odd crores. And overall, this was quite onerous, which immediately caused the 10-year benchmark to jump by about 25 to 30 basis points. And only after cancellation of an auction, the yields cooled off by about 5 to 7 basis points. Now, today, in the RBI monetary policy, uh, to the surprise of everyone, RBI held on to all the rates. Market was anticipating a rise in the reverse repo rate by 20 basis points. This was a widely anticipated move by the market. Um, Contrary to that, RBI held on to the rates, both the repo rate, reverse repo, as well as the stance at accommodative. This basically surprised the market, and to the consternation of the market, they projected FY23 inflation at 4.5%, which was quite aggressive from a market perspective. Most of the economists think that FY23 inflation will be in a handle of about 5 to 5.5%. This aggressive stance from RBI has been explained from a perspective of that food inflation in India has been at a lower clip than the global food inflation, and government supply side intervention have worked well in controlling the inflation. This works well for India in the sense that if you look at if you compare India with the global peers, what we see is that India's inflation target is between 2 to 6% and a median target of 4%. India's recent inflation number was 5.6%, while the upcoming inflation number is anticipated to be around 6%, again between the 2 to 6% band. While if you look at, say, for example, United States, UK, Europe, all these places have an average inflation target varying with the degree of flexibility which the central banks have adapted for themselves to pursue this target of 2%. Uh, it is running multiple times, anywhere between 2 times to 3 times of the official inflation target. Now, this is what is not there at Indian end, and uh, what RBI is banking on is that going forward, the supply side bottlenecks will ease off, and one of the major commodity, which is crude, is likely to ease off as the supply of crude improves. Now, this is not taken well by the market in the sense that markets sees this as a major risk. With every $10 rise in crude, India's current account deficit increases by close to about 0.4%. This is something which is detrimental to India, particularly when we look at Indian side, we are a net importer, and we need dollar savings, dollar from overseas markets, and that is something which I think RBI is right now comfortable because they built up a war chest in form of the forex reserves close to about 632 billion, and it implicitly has import cover of about 10 to 12 months, depending on what kind of import levels are there. and with exports likely to pick up as India takes a more aggressive stance in the global supply chains, um, this is likely to be beneficial to India in terms of from an external perspective. Having said that, I think it's a big ask for India in terms of the challenge which India would have to face as if the inflation is higher than what RBI is anticipating. But from a RBI perspective, this gives them a leeway in terms of maintaining repo rate at the current level of 4% for a longer period of time, and gives an opportunity to India to have a durable growth set in before the rates rise in the economy. Um, it is a challenging ask at this point in time, because what it looks like from a global macro setup is that most central banks in the developed economies are raising rates, winding down their loose monetary policy, and of them have already started raising rates. And it is widely anticipated that Federal Reserve is likely to raise rates in its upcoming policy in month of March. Having that context in place, it will be very unlikely for India to buck the trend, and most likely India will have to follow suit at some point in time. But I think right now, with the huge government borrowing program, the RBI stance is to delay as long as possible and give an opportunity for the growth to set in, because lower interest rates give a chance of borrowing at a lower cost. And the market is a little worried in the sense that they think that RBI's hand will be needed even this year, particularly in a much more challenging macro backdrop and an increased gross borrowing program. So, despite the fact that most of the market participants believe that the government has been very conservative in budgeting the numbers, and there could be a fiscal space of about 2 lakh odd crores, and supply demand could be much more realistic if that space comes up. That will only time will tell that how things pan out, because most likely this year will be the year of normalization, and we would see things getting back to normal, which will basically means that loose monetary policies will be toned down, and even if you don't see any aggressive rate rise across the economies, but what you would definitely see is that extraordinary measures will be withdrawn, and possibility of a rub-off onto India by various global central banks winding down their purchase programs and tightening their policy will be felt during this fiscal year. I think RBI is cognizant of that fact, and uh, they know about it. But I think the current borrowing program of Government of India is keeping them maintaining that stance, since they are the manager to the government borrowing. Uh, Having said that, I think in the fixed income markets, there was a chair, because market was not expecting RBI to be this dovish. So this level of dovishness has given a kind of chair, and the market is believing that RBI will be there to support the government borrowing and the markets at any given point in time. This will be tested to the hilt going forward. The public goods, the, the yield curve being a public good, will also be tested going forward. I think this is something which will be very challenging, and uh, we have to see how it pans out over the next year, particularly in a change macro setup. From a fixed income perspective and from an investment perspective, we maintain what we have been telling our investors earlier. We say that the only change which we see right now is that if RBI is successful in maintaining the repo rate at the current levels, the steepness in the curve could continue because there will be a supply demand mismatch at the longer end, and which could push up the rates higher than the current levels going forward. But if the repo rate is maintained at the current levels, we could see the current steepness in the curve to continue, and that gives an opportunity for the investor to move up the curve and to avoid or preclude volatility. They are best advised to follow a moderate duration strategy, where and that too we recommend it only for investors who have a time horizon of anywhere between 18 months to 24 months, which they can move up to 2 to 3 year duration bucket. While other investors who have a shorter time horizon, they should match their duration with the product. So people who are ultra conservative or very short time horizons in the fixed income market, they are better off by investing in overnight liquid, uh, ultra short, and money market funds. Uh, it will be a challenging task for RBI to take through the borrowing, but with the past experience, what we have seen, it will be a combination of OMOs, both open market genuine operations, which could be in the form of operation twist, as this kind of liquidity which is sloshing around, which RBI would like to continue, and they will not like longer term instruments to be used to disrupt the government borrowing program. But in case the credit picks up during the year, there is a chance of the liquidity drying off. But the kind of liquidity which we are witnessing currently is unlikely to be sucked out uh, with what we can see on the horizon in terms of the credit offtake. So what we anticipate is that it will be more of liquidity operations from the RBI, which will drain out the liquidity than the credit offtake going forward. So I think that is an important metric from our end, which we would like to watch in terms of liquidity tightening. I think we don't foresee it immediately, and that could aid the government borrowing program around in and around that time. If they keep liquidity to the levels where they are currently are, it is likely to support the government borrowing program. So that is one thing. It could be inflationary, but I think till the credit offtake happens or the demand in the economy comes back, which is not the case currently, I think inflationary pangs will only be supply side. And supply side inflation, as RBI anticipates, will be handled well by the government interventions. So I think keeping that thing in mind and understanding that growth, durable growth is much more important at this point in time. I think RBI has acted in the right direction, and we have to see and how the RBI does a balancing act going forward, particularly looking at the situation where India needs foreign currency at any given point in time, at the time when the global monetary policies are out of sync with India. So I think that will be interesting to note and see how it pans out. Um, Thank you, and best of luck.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.